What's up, outliers? Happy Friday. Welcome to another options trading for beginners session. Believe it or not, we're running out of these. I have a handful more that are in the docket, and then we're going to switch this series a little bit into something else. So enjoy these while they're here, because they ain't going to be here forever. All right. Let me get this chat over here and let's do a quick rundown. First, if you're here, don't forget to say hello. That's the whole point of doing a live stream, is to hang out with you all, as compared to making videos by my lonesome, which is way less fun. Although I'm not even going to lie, the video that I made today was pretty enjoyable. I looked down at the time and I realized I'm essentially at what, 25 minutes was that video earlier today. It was nuts, because I ended up just kind of rambling about this story because it was nuts, but really fun all the same. We are loaded up on beverages. We have the blackberry lemonade from Waterloo. Then we have mandarin orange from Kroger. And then we also have a Spindrift raspberry lime. So I am essentially almost positively going to need a pee break, but I am not going to need a break to go get liquid, because I have quite literally a plethora of them. So I'd love to hear how your trading week was. And I want to say hello to everybody. I see we got Tom Benoit, The Sheet. What The Sheet? Good to see you. Brenna Gay, Jason, Elong Songs, Mac Chicken OG. What a name. I love that. Kenny Wu, love that. Reese, Eric, it's my doppelganger. In case you guys didn't know, there's another Eric, which is really, really cool. Steven, running DGen. Aren't we all DGens at the core? Shrey J, Mike. We got everybody hanging out. Shane Soldner. That's a hell of a name too. I'd like, my mind goes soldier there, which would have been completely wrong. All right. So what's the deal for today? Well, there are two big things. The first thing is I want to work through this list with you guys, understanding common options trading misconceptions. That's the first thing. The second thing that I want to work through with you guys is taking a look at specifically what kind of misconceptions you've heard. And as always, my intent to go through this session is we should meander all over. So if there's a specific thing we're talking about from this misconception list that leads into a rabbit hole conversation about a specific trade that was put on, that is cool. That's the point of live sessions. If I want to do a discrete video about this, I would do a video just about this and post that, as compared to doing a live session. You get the point. So I just want to encourage people. At no point of you bothering me or anything like that. All right. That part aside. Renegade says, you see news on Andrew Left. Yeah, man. You must have not seen the news on the video that I put out about Andrew Left. I spent like the first half a day, or I guess like half the afternoon, talking about this dude. So that video is for you, because I am aware of Andrew Left, and I actually think it's a really, really interesting update to the GME story. H says, love the content. Thanks for putting this style of information out there. Awesome. Yeah, I love that. That's great. That's absolutely great. Steven says, let's look at Bitcoin. Yeah, I'm happy to start there. In the meantime, I would like you guys to let me know what you saw this past week in the markets. The reason why is a lot of the sessions that we're doing, they're predicated on this idea of, understanding the theory and the background behind options trading. Now, one of the things we're going to do today is actually review a trade that I took off last week, so that we're integrating more and more and more practical application. That's where this all goes. You can understand the theoretical aspects of options trading inside and out, sideways, backwards, whatever other dimension there is. And it doesn't matter unless you can figure out how to use them to make money. So we're at the point in our journey together. I don't even know which episode this is at this point. You guys might know better than me. I can't even see it. It's kind of annoying, actually. The title cuts it off here. What episode are we on? Is this like 8, 7, something like that? 8, maybe? And so we're at the point now where the groundwork has been laid, and we need to start pivoting the way we think about markets to the practical application. Jason says 8. Perfect. That's useful. Yeah. So 8, episode 8. We've been through a few of these at this point. And the reason why I'm drinking a lot, by the way, is because I just got a shit ton of cupping done. And you're supposed to have a lot of fluid to help flush all that madness around. So my right leg right now looks like fucking hamburger. If you guys want to see it later, maybe I'll flash you my leg, but it looks nuts. I get cupping done fairly regularly, but the leg is bad because I have like a inflamed thing going on. You know how it goes. It's 33-year-old white man problems. As I'm training, more shit is breaking and I don't see it getting better. So now I'm having them put suction cups on me to keep me together. That's the thesis. Will Stretch Joe, good to see you. Let's say, okay, let's now go back up and let's take a look at Bitcoin. Bitcoin was up today. I mean, I don't know. It's not doing anything exciting to me. To me, it needs to be above this level before I really care. Essentially up there. This is the way I think about it. Because Bitcoin has been pretty range bound for a while, right? So it started basing down here. So I care about it if it's down below this. And then, okay, sometimes I do stupid things. Like the stupid thing I did there was not change this. I thought I changed it, but I didn't change it. And wait. Okay, so I didn't mess that up. What's happening right now? Why are these alerts? Are these like not good till canceled? What's happening here? Oh, duh, because it's N24. See, like I just said, I do stupid things sometimes. So anyways, it's because, so in case you didn't know what was going on there and why there was a problem, it's because they're good for this expiration, which is essentially is now. So they're not sticking. And then I think when you put these in different groups, yeah, so like you have to pick which expiration cycle you want. So that was my bad. That was my bad. I did do something dumb there. But anyways, this looks really range bound to me. It looks like we had lower lows, higher low, slightly higher high. Like this was a bit of an inflection point in my opinion. Then it just glide slope down. We based out here. So this tells me obviously people are willing to transact at this level and it's starting to drift back up. But I mean, to me, this point of control is going to be a little bit of a problem. It looks like it's already starting to break through. So this can definitely start to look like support once it gets all the way through. But it just looks like a lot of congestion right here. So essentially, before it starts getting above those levels, I don't necessarily see like a massive story here. I maintain a position in Bitcoin just in the underlying itself, but that's mostly just because Bitcoin, I think, is interesting and I view it as a disruptor, and that's the reason why I like it. So a slightly different thought process towards these, but yeah, I mean, happy to take a look at it. If there's something specific that you're seeing, I'm always down to discuss that, but at least from my perspective, this doesn't look too, I don't know, too interesting yet. Now, I want to talk you all through a couple things from the past week, just from a broader market perspective. The reason why I want you guys to like hear some of this information is because I think it's really important to be able to see how these different things start to fit with one another. So that's really what I want to talk about specifically with this past week. So I want to take a step back and go here. And I want to walk you guys through some of the broader trends as far as I see it from the past week. And if you look at just this chart, these series of charts, before I even say anything, what do you think one of the things is that I would talk about here? We got to stand up. Ugh. What sticks out to you here? Sneehill says, I thought today's live was GME. That is incorrect. And I'm sorry to break your heart. The GME live stream is tomorrow. The Friday live streams are options for beginners. So this is where we're kind of going through the basics of options and stuff like that. So a little bit of a different focus. So yeah, sorry, Sneehill. Well, I mean, I'm not really sorry. I've been really good about publishing the dates with what is when. So I'm not so sorry about that, to be completely honest, because I know I've been pretty clear about it. But I guess the part I'm sorry for is that it would make me sad if I was going to a concert expecting one band and it was a completely different band. I wouldn't like that. So I don't blame you for being in here and being like, what is this all about? I don't blame you. And I feel bad for that because I was hoping that it would be closer to your expectations. But yeah, that one's tomorrow. And for those that are interested in that live stream tomorrow, the game plan is really, Newton's not joining me for this one. He can't make it. He's going to start back up on the next one. Next week, we're going to connect again because we're both doing a bit of research. But my game plan for tomorrow is actually to go pretty deep into watching some of his old videos and stuff. I've been collecting some that I want to work through. It's just to learn. That's essentially the goal for me tomorrow. And that's actually why I was asking people for help, because a lot of folks, especially in the chat, are way, way, way more abreast with like the history behind this whole thing. So that's the goal for tomorrow's live stream. Today's options for beginners. So it looks like a few things I see. Tom is bang on, as would be expected. He's typically on top of some of these broader trends. And this is a really important one because one of the very clear things you're seeing is strength in small caps. That's super important. The reason why it's super important is because that in and of itself opens up a series of trade opportunities if you are a discerning trader. So you can think of things like pairs relationships and pairs trades. You can look at relative value between the different indices and where they're at. You can look at macroeconomic factors and how right now small caps are trying to front run the rate cut that we think is coming. So the reason why I want to draw your eyes to something like that is because you have to get in the habit as a trader of looking at these things. You have to have a specific process that you go through, because if every day you open up the platform and it's just kind of like whatever blinks the brightest to you or whatever, like you're never really going to see anything. You have to take the time to make deliberate scans and things that you want to look at, in particular, analyze relationships, because then it starts to breed trade ideas. Now, to give you guys a little bit of background on this, anybody that's been in my community since the beginning of the year, you guys know that I expected this to happen. Now, I want to be abundantly clear. This took longer than I thought. And I told you guys that as well, because I originally structured the whole IWM/Russell trade under the idea that we originally were looking at rate cuts so much earlier in the year, and then everything changed. And guess what? Markets do that. Markets change. And that actually goes into one of the misconceptions we're going to talk about in a little bit, because one of the hallmarks of a trader is the ability to adapt to changing environments. So again, going back to the community, as I'm doing YouTube live streams on Monday, talking about the stuff that I'm doing, there was a while back that I told everybody that I pivoted out of small caps. And then I pivoted back into small caps when I saw them start doing what I thought made sense. So if you can start identifying broader market relationships, the idea of doing that sooner rather than later is only going to help you. So there's a reality behind time and tenure in markets, and it just takes time observing things. You can't fast track that. You can only see things as fast as they happen. So what I recommend to people is just take the time, even if it's just for a few minutes. It doesn't even have to be while the market's open, but take the time on a daily basis and try to look at a few things consistently for a set period of time. So for example, pick something like the Russell and just follow it for a week, just a week, but make sure you look at it every day for that week. I guarantee you'll learn something. I literally guarantee you will learn something. What it is, it depends on what you know going into it. But by being specific with some of these things that you're literally drawing concerted focus towards will help you. So yeah, that's one of the really important things that happened this week. There's another few things that I think we can draw from this past week. One of which is the market's perception still of the rate environment that we're in. So if we grab this and we look at news, right? So this is from this past week, and we take a look at some of the things that have happened. What's happened? Well, home sales came in a little bit light. That matters. Again, once you start getting in the habit of analyzing these things, the first flow of my thoughts when I see this is, how are small lending banks doing that would typically finance these things? How are materials doing? How are builders doing? There's immediately trade themes that you can come up with just from this information. Now, this is the cool part, is you could decide if you're trying to play more thematic things that take way longer to unravel, or you could literally play the digestion of this information. Because even though as a retail trader, your propensity to be first in line to see this metric come out and trade it is essentially null. It's probably never going to happen. That doesn't mean that you still can't make money trading information like that as the broad move gets priced in. Because this is exactly how we get into these instances where stocks become so beat down or so elevated. And that's because price is not always rational. It gets pushed to these extremes, and then it slowly oscillates back to normal levels. It's very common. It'll continue to happen, and this all comes down to an observable market effect that's tied to this concept called information discreteness or indiscreteness. And it's this idea that in order for new information to be integrated into market pricing, it's not an instantaneous thing, and people have different ideas about it. So it leads to what we call noise, price noisiness. So something like this, that's just kind of bouncing around, and then it just randomly hits 1633.67, and then it decides, oh, that's it to the downside, and then it starts going up from there. That's noisiness. This is not a clean dissemination or integration of information, and it leads to extremes, tradable events. So to wrap down this thought here, let's take a look at a couple other things from this past week. So we had the composite from S&P PMI, we had the services, global services, and global manufacturing PMI. Why would all of these matter? Why do I care about these metrics? And for those that don't know, I want you to take a guess. If you do know, you don't have to answer because you already know the answer to this. But if you're not sure, if you know, I would love to see what the guess is. Shrey J is a great question. Shrey J says, what are your thoughts on XLB strength despite poor housing data? It's a great question. It's not causal. It's not causal at all. So just because home sales are up or down, one, the miss was minor, very minor, literally 3.89 versus 3.99. So this is not any sort of giant miss. But the other thing is you have to, again, zoom out into the broader macroeconomic picture. What do you think home builders would be doing in an environment where they think rates might start to come down? What would they do in that scenario? And that in there lies most likely than not the answer to your question. The sheet, what the sheet says rate cuts or not, depending on PMIs. Yeah, that's great. That's exactly it. And Jason's concept of build, based on what I was just talking about, what the builders might be doing in this scenario, is exactly correct. So that's why, because this missed by 3.89 versus 3.99, that's why XHB doesn't care. There are other factors right now that are overwhelming that data. That's the cool thing, right? Because this is new home sales. This isn't new home builds. This isn't build permits. Take a look at build permits, this next line. 3.90 versus 3.4. It essentially tells you the inverse of that, right? It's important to look at individual data points. The example I was giving before when I said looking into those when you see these, it's just to get people thinking about where to look after you see these data points. But it's not that they're causal relationships, because they're not. Shane says, I don't know what those things actually mean. That's literally great. I'm glad you said that. Let's take a really quick look together. We don't have to dive super far into this. And the other thing is, I actually want to steer you guys away from looking too far into economic indicators, because it is a little, I'm not exactly sure it's the best use of your time, is the easiest way to describe it. But there is usable information. So when you look at stuff like PMI, you can see whoa. Oh, it's this. I was like, where the fuck did I just get a chat ping from? So this is looking at a certain set of data, right? And you can see essentially what's built into the data, what's built into the surveys, and what you can deduce from it. Now, if you think about what's topical right now in the market, it's anything related to inflation. Anything related to cost to produce things, all of that is under a microscope right now, because we've been in an elevated rate environment for some time. That will change. That's not always going to be the case. This is not always going to be the most important thing out there. And that's the cool part about markets, is that during the bull market that we saw essentially from 2010 until COVID-ish, there was a bunch of other things that mattered way more than stuff like this. So the idea is to try and identify what matters at a given point in time from a broad perspective, and then find supporting data points that help us assess where we're at in the specific broader picture, so that you can come up with ideas. So that's why right now stuff like PMI is actually really, really important. So Shane, that's what the data is. It tells us different economic assessments, really. And you can take a look. There's different people that do these. So this is S&P Global. There are some there's ISM. That's another really common one. And they'll have difference in what they report and shit like that. It's the same kind of thing. Is looking and carefully tracking these kinds of things will give you some ideas on where we're at in a market cycle. So that's why I think this stuff matters to you. Nick, what up? Good to see you as well. Shane says, is PMI private mortgage insurance? No, I just showed you what it was. You got to work with me here. I literally just showed you what it was. I got to grab the website again. S&P PMI. Oh, it's right there. I'm an idiot. Right there. So do you see? I'll throw this in the chat for you so you can take a look. And then you can take a look at the actual reports, right? And you can see what's in there. The sheet also is not correct. It's a great guess, but that's not it either. Fantastic guess. Very close, but not exactly quite. In this case, it's the Purchasing Managers Index. So there's PMI, which we really care quite a lot about. There's a couple other like larger ticket economic releases that matter to us more than others. Another important one, believe it or not, GDP, which is a recent one from this past week. And GDP came in good, actually surprisingly good. I think the market and most people in general were pretty surprised at where this came in, 2.8 versus 2 expected. That was much higher for the prelim for Q2. That was interesting. Then there's PCE, which is another important inflation style metric, 2.9 versus 2.7. So what I'm highlighting right now are just some broader macroeconomic measurements that matter to the current market to varying degrees, and you should just be aware of them. So as you look across the previous week, these are some of the important things I think that show up here and that you should be aware of. So that is that. All right, let's get over to some of these misconceptions. What do you guys think of this very first one? This first one says, this is how you make $500 a week selling covered calls, or easy passive income. Are these things that you've seen, or are these things that you've believed for yourself at some point? I'm going to type in, actually, I'm going to grab a private window so that it's not skewed by any of my search habits. And then I'm going to go to youtube.com, and then I'm literally going to type in options trading. That's it. And I want to see what pops up. Let's see. So we have full free course. That's fine. This is fine. Here you go. We're right off to the jump. If I wanted to make 1,000 a week trading options, what does this even mean? Right? Like, I'll tell you what this is. This is really good branding designed to capture somebody's attention that's like, oh shit, I want to make $1,000 a week. Who doesn't want to make $1,000 a week? I make more than that. I still would like to make that too. So why not do this? Right? Like, it's natural. And unfortunately, a big part about this is appealing to people's issues, specifically the desire to make money fast. So this one, actually, Project Finance, Chris, I've talked with him a few times. He's a buddy of mine. He's cool. And I like the stuff that he does. We have very different approaches to trading, but I like his stuff. I just want to see what else is in here. There you go. 91% win rate, right? Who doesn't like a good win rate? And believe it or not, that'll actually be one of the things we talk about in here, in this back here, is why, in my opinion, that's probably one of the worst possible things to focus on as a new trader, which, you know, no big surprise there. I think it's hilarious that that's a common thing. So anyways, what I'm trying to highlight to you, it's not to go through and, you know, poke at these other YouTube videos and stuff. What I'm trying to highlight is the shit that's put in front of you as a new trader. And the fact of the matter is, options are complicated. They are not impossible by any stretch. You do not have to be a genius to figure them out. I am clearly proof of that. However, it's not a place for either of these, is what it comes down to. Could you make $500 a week selling covered calls? Of course you could. But what this comes down to is, this is how you make $500 a week. What are the things that just trigger in your mind? $500 every week. That's not going to happen with that. Not going to happen with that. But it leads you to believe that that's true. And the issue with that then is, then you start this world of trading with this really contorted mindset, and it sends you down the entirely wrong path, in my opinion. So that's why we don't like these ones. The idea of easy passive income, in my opinion, it also sets traders up for the wrong experience, because it's focusing on this idea of easy. And then as soon as we start having to do difficult things to be successful at this, well, we struggle because we started thinking that this was easy and passive. So to both of these in the beginning, I would offer a counter data point for you. So I'm going to go to my website, because I'm still building this out for you guys to have kind of some different resources available. And in this tab here, there's a bunch of different things we can look at, but one of them I want to show you is this right here. Right? So if we're looking at something that you can make $500 a week selling covered calls, or it's easy passive income, then how is it the case that we see these issues? That after 5 years in the market, generally speaking, 7% give or take of traders continue trading, where even a small cohort of them are not profitable. Why is that? If it's easy passive income, or if this is how you make X number of dollars a week selling covered calls. Why is that? Or this, why is it that of this 7% that continue trading, why is it that such a large number of them underperform the market on average by 6.5%? That's what this number is, by the way. I know it's a little confusing. Why is that? What I'm highlighting to you is all of this stuff, in my opinion, sets you up with the entirely wrong mindset to be successful in this long term. I would encourage people to actually do something slightly different, which is this. Understanding why this matters to us, right? So this kind of sucks if you think about it. The average income in the US is 94K, median is 74, average retirement is 61, lifespan is 77.3. That kind of sucks. So you essentially work your entire life and then you look to retire when you're 61, where, as I already mentioned to you at the beginning of this video, I already have, I think, like a partially herniated fucking disc, and I'm having to go to physical therapy like I'm 90 in order to move healthily, and I'm 33. So I'm real eager to see what this whole thing looks like for your boy at 61. But my guess is I'm probably not going to be able to do the same shit that I can do today then. That's probably what I'm guessing. And then if you're lucky, you get to enjoy that for 16 years. It's good. 16 years is good, but you only get one shot at this life thing. So then you start with that and you start to realize, well, a lot of people don't do a great job at this. So then starting this entire process with this in mind, that trading, just as it can enhance your wealth, it can just as easily destroy it. Why would I say that? Why would I throw that out there if the idea is to try to help present information in order for people to figure this thing out? Well, it's the same thing like if I'm coaching somebody in boxing and I put them in a sparring session and I just say, oh, it's easy. You'll be okay. Just go in there and move around. You'll be okay. You'll figure it out. What's probably going to happen to that dude in the ring? He's probably going to get the piss beat out of him. And after that, we're going to have a really tough conversation because they weren't ready for that experience. They're now questioning if this thing is for them or not. Or maybe a better approach to that boxing scenario is if I have a friend, I put them on a heavy bag for a little bit, then I put the mitts on and I work with them for a little bit. I let them watch sparring sessions so that they could see what it looks like. And then before that they go in there and they start doing a full spar, we move them at 30%, 50%. We ratchet it up. Then what happens? What's the difference in that experience? Well, in the latter experience, you are prepared to get punched in the fucking face because it's gonna happen. But if you start this without that expectation, when it happens, it completely derails you. So if you walk into this trading world like most of us do, hoping for quick, easy money, and that's your base expectation, and as soon as you start to realize that it's not quite like that, it becomes very difficult to continue because you're like, well, this isn't what I thought it was going to be. Do I want to continue doing this? Which is a great question to ask yourself. But if you go into this understanding that in the beginning, it is hard. In the beginning, you have a long way to go. But, however, if you're able to turn the corner, then all of a sudden it becomes worthwhile. I thought I had another thing in here, but it's in here. Here, this is it. This is what it's all about. So for those that ask, like, how long does it take to get really good at this? If you spend 5 hours every single day without fail for 5.5 years straight, you'll hit that typical 10,000 hour mastery level. 5 hours every single day for 5.5 years. A lot of people grossly overestimate how hard they're working and how fast they're learning. And it leads to this over here, which is a very common wealth depleting effect. Then we have a terrible experience, and then we have a choice. Do we continue this path or do we not? Because here is the beauty, and this is the absolute truth. Trading for me at this point genuinely is easy. It is mindless. What I do as a trader is easy. But that's because literally all of the work is done before I click a button. Everything is done before I click a button. All of the hard work is completed before I have the luxury of being able to put a trade on by tapping my screen. That's the reality. So if you can embrace this slope of learning, and if you can embrace the learning process, there is a light at the end of the tunnel, but it's not a quick, short tunnel. That is the objective reality of this. And it's super important for you guys to hear that so that you don't come into this with the wrong mindset and then go through a phase of lighting your own wealth on fire, trying to do stupid things. That's number one. We got 11 more to go through. Some of these will be a little bit faster, but do you guys have any questions on this one? Or this is a great time for any injections or moving around anywhere else. If you have anything else you want to look at quick. The sheet says, I've been assuming the worst. I've been trying to get my process with as many risk mitigations as possible. That's a good idea. But the problem is you can't become too risk averse either. You have to have a really solid balance between the two, in my opinion. So I would be very careful with that idea of as many risk mitigations as possible. I'm not even sure that that's the right focus there. If that were me, I would be focusing on the proper risk mitigation. That's what I would think. G33 says stock goes up, call options go down, WTF. That's easy. There's a lot of reasons why that can happen. You're fighting a lot of things with call options. You're experiencing stuff like theta decay, where the value of your option is eroding every single day. You're fighting things like changes in volatility. So if the stock moves up a little bit, but not enough to overwhelm theta decay, you'll lose money. Or if the stock moves up a little bit, but not enough to outpace theta decay plus a change in volatility, you'll lose money. That's the tricky part with options, is that it starts to bake in new elements into what can happen in our trade. So for example, if we're looking at something, we'll use GME. If you're looking at something like GME, and the reason why I think this is a good example, I'll explain why I think it's a good example. Because let's say that you're trading GME, and let's say, let me get rid of this. Let's say that you're bullish. And let's say that you've been in this game for a while and you're trading GME from a long while back. Well, one of the problems that you will face with something like GME is because it is heavily volatile. So your options are going to move as volatility changes. Take a look at both the 30-day and the 7-day vol for literally the past week. It's moved meaningfully. So if we take a look, today is what? The 26th. So if we go back to the beginning of the week here, your 30-day vol was like 171 and it landed today at like 137. That's a direct input into the value of your options, and it just cratered. That does not help you. The other thing with options specifically is that you need to move in a certain time frame because you're holding a decaying asset. So for example, let's say that you go back between, the two squeezes that we've seen. Let's say that you're somewhere in here and you're like, man, there should be another one soon. I mean, you had a couple in here, so let's even cut those off. Let's say that you're getting in somewhere around here, like early 23, and you're hoping for a movement. Nothing's happening. Well, what is happening is your options are eroding. So what that means is that if you eventually get a move, you now need a bigger move to compensate for that holding duration that you were in. And for a lot of GME options traders, as far as I can see, they structure their trades terribly. And they're using these really short dated options that decay super fast. I talked about that as well in the video today, because what I saw was, this surprised me actually. The fact that more people opened these yesterday into today, I did not expect that. And I called that out in the video, by the way. And the reason why I did that, just to call it out here in case you haven't seen the video, is I think it's important for people to realize that people get shit, myself included, wrong all the time. So I would have guessed something else here. I literally would have guessed that the vast majority of these people would be rolling their options out further in time. But there was clearly enough yesterday into today to have a net positive inflow into these, which that genuinely is surprising, but it's also shouldn't be surprising with me anymore with GameStop. I should know better. Now, if I take a look at where they're moving into, though, it's very clearly here, right? The 25 strike next week. There's 10,500 OI against 15,000 new volume. So there's already essentially a very clear add 4,000 plus going on here. What's going to happen? Well, they're losing 7 cents every day on something that's worth 65 cents. So you have your $7 decay on something that's at 65 bucks. 10.77% of the options value decays every day. And the fun fact is that's going to get worse. As this gets closer to expiration, as a percentage of the remaining premium, this will get worse. So that's a big problem here. So all of that is to go all the way back to, whose question was that? Where was it? G33. That was to answer your question about stock goes up, call options go down. That's why. It's not that relationship isn't as you're describing it. You're just missing the rest of the nuance that goes with it. So yeah. Shane asks, what do you do with your unallocated money? Do you leave it in cash? Do you put it in TLT, or do you do something else with it? Yeah, it's a great question. So the majority is going to be put into things called box spreads because they get a better yield. So here's a video about box spreads. And then there's a log for those interested in learning how to analyze box spreads. That's what I do with my money. So capital that's not being utilized, I use box spreads for a bunch of different reasons, but it's because they're highly adjustable to whatever time frame. There's a couple really important traits when you're trading something called a box spread. The first one is you need to use a European style option that has no early exercise. That is a massive risk if you're trading box spreads, and especially if you're not expecting it to be there. There was somebody on Reddit that traded a UVXY box spread that they didn't know this. So this isn't actually what happened, by the way. This is, oh, let me squish this down. I think this person is trolling somebody else, but this is a joke, right? But they're trolling somebody else from here. So essentially, maybe it was this person. But anyways, they're trolling. So there was somebody who had a UVXY box spread on. And the problem with UVXY is that it's not a European style option. It has early assignment. So it has a ton of risk, right? So again, this person I think is trolling somebody else. I forgot the name of the person who actually did the real trade, but this is what that person thought. This person thought that they were putting on a box spread, which if you're buying a box spread and you're doing it correctly, it is a risk-free trade. However, if you're not paying attention to the products you're using, there can be a ton of risk. And that's what happened to the person doing this. They were using UVXY because they were able to get a shit ton of money because there's risk, but they didn't realize that. They thought it was risk-free. So they thought it was a really good risk-free return, which obviously wasn't. So that's a big problem. Wheel Stretcho says, any European style option have a dividend? That's actually a great question. I don't think so, because most European style options, at least like these, they don't have an underlying. Like there would be cash settled. Let me see real quick. Do any European style options have a dividend? It's a good question. They do not. Oh no, this says index style options. And then this one says no, European styles do not usually pay a dividend. So yeah. Because what they're doing is they're equating right away European to index options. Rutavegas says, what's a European style option? Yeah, a good example of that are the indices. So like SPX, this is a European style option. You'll notice that there's no underlying, right? There's no volume. There's nothing that trades here. So European style options are options that have no early exercise, and they're typically cash settled. It's one of the two types of options that exist. There's American, which is mostly what you're used to seeing, and then there's European. I think this is in here. Yeah. So we would have went through this in one of the earlier videos that we did, but it's totally cool to go back through. So the main component of a European style option is that there's no early exercise. Now, there are a lot of reasons why that matters. It matters in terms of pricing. It matters in terms of risk assessment and things like that. But the other component is that many European style options are also cash settled, which is a really important component, because there's no underlying that moves. It's just settled to the value at that point in time. So that's why using something like a box spread in a European style option is so important, because early assignment induces risk that otherwise wouldn't be there, which we're not trying to have. Tom says, are you only using box spreads for capital allocated to the CS strategy? No. I use box spreads for everything, man. Any unused cash in the portfolio, I will absolutely put into something, unless I'm planning on using it soon. Now, normally I leave a little bit of money easily accessible, right? So like because like as a trader, I also don't know when opportunities are going to come up. So I'll leave like a few $100,000 that I can tap into whenever I want. But like the majority of unused cash is going to be put to work in some capacity. So I'll put it in typically a box spread. Now, to your point, a lot of times that includes capital that's already allocated to other trades, but it's not being utilized yet. So it's not always in one single box spread, right? Because I need to deconflict by time the different box spreads that I have out against when I think I need that money. So it makes a giant difference in terms of when I want to use the capital, how I set up the box spread, how many of them I need to have on at a given point in time, how much the box spread is worth. All of that is variable, but it's all going to start with trying to use the capital. Now, this is relatively new, especially from what I would have been talking to you guys about, because if we go back to pre-COVID, pre-interest rate increase, there was like no yield. So if you put money in anything trying to earn something on the cash, it didn't really matter, because you're earning so little that really you're just sacrificing liquidity. It didn't really matter that much. So yeah, the short answer though, it's definitely not just relegated to stuff allocated to the coverage triangle. It's pretty much for everything. Good question though. All right, let's get on now to our next one. The market should have done X. What do you guys think about this? Why is this a misconception? What's wrong with this idea? What do you guys think? The market should have done X or Y or Z. The notion here being that the market should have done something else. Renegade says unforeseen circumstances. Nope, not it. That's not it. The market is irrational. That's not it either. Hater says we don't control the market. There we go. Rutabaga says no self-accountability. There we go. MRAM says views too narrow. You missed something. Could be. Enoch says the market will do what it will do. There you go. You guys got it. So the market should have done X is stupid because it infers that what you think should have happened usurped what happened. The reason why it did whatever it did is because the rest of the market did that other thing that you said shouldn't have happened, but the majority said it should, and that's what they did. So the problem here is that for this kind of trader and for this kind of mindset, you breed massive problems because you start to overvalue your assessment of what should or should not happen over whatever is happening. And it's a really weird concept to get used to, but at some point, you literally have to relinquish yourself to the market. I know it sounds really weird and esoteric, but what it means is even if you have some of the highest conviction ideas, if the market is not agreeing with you, you have to reconsider them. So for example, a great version of this is The Big Short, specifically when he had these custom swaps made essentially on the mortgage-backed securities, and the premium that he was paying on them was literally about to make his fund go insolvent. As much as that turned out to be the coolest story ever, where Michael Burry stuck to his guns, he really knew it was going to happen, and then it happened, you had better believe there was a massively healthy dose of fucking luck. All the hard work in the world went into identifying the opportunity. The luck component really came into the timing of the opportunity because he almost had to close his positions because he was way too early and he was going to go insolvent. He actually had to go DEFCON 5 and essentially disallow people from pulling their money out of the account because if they did, essentially the play would have died. So that kind of thing is really important to acknowledge because even when we see these really, really cool stories, you like, who doesn't love what Michael Burry did? It's one of the coolest things ever. But he was super fucking close to that whole thing not working, mistiming it, and having an entire fund blow up. So while it's really cool to look and acknowledge those really interesting scenarios, it's important to understand survivorship bias, which is exactly what that is. We're looking at a successful result for maintaining conviction, and we're not seeing the litany of unsuccessful results stemming from the same exact strong conviction. So what I'm highlighting with number 2 here is nobody, literally nobody, gives a flying fuck what you think should happen. Nobody cares. I don't care. Nobody cares what I think should happen. Nobody cares. It is really important to understand how to interface with markets. This other idea of markets can remain irrational longer than you can remain solvent. I love the saying, but guess what? If the market is remaining irrational for a long duration, what does that tell you? Is it irrational then? Maybe it is. I'm not saying all instances is not. I just told you in the beginning of the stream that prices can get pushed to extremes that don't make sense. That can happen. But what I'm highlighting is this idea that it's almost like where people will place themselves way higher than they should be in a hierarchy and essentially saying that maybe the market is doing what the market thinks it should be doing, and maybe we're just being ignorant and stubborn, and we don't like that it doesn't align with what we want it to do. This idea of the market being irrational longer than you can be solvent is complete bullshit. It's worrying about the wrong thing. It's literally a giant series of bias that are happening in that instance. And again, it will skew your thoughts heavily. Let me grab this. this is another thing that I'm working on for resources for you guys. It's this one. It's a giant list of all these different decision-making faults, cognitive biases, and all that kind of stuff. All that really fun stuff. And there's a few things in this kind of scenario that really, really stick out to me. But this one is a massive one. And there's cognitive bias. And there's another one that I'm thinking about in particular. I want to see if I can find it quickly. No. This one. This one right here. Blind spot bias. It's the perception of being less biased than other people, and essentially your desire to assess others as more severe. So that's what that boils down to, is when you say the market is irrational or can remain irrational longer than you can remain solvent, that essentially means that you think you're so unbiased in your analysis of things and the market is biased. It's complete bullshit. All right, next one. Mike Williamson says herding. Yeah, herding is a really common one. I think, where was that? Towards the bottom? Or did I miss it? I might have taken that one out. It was literally on here because I wanted to pick a weird number. And I'm going to continue building this out. I don't really care how long this one gets. But essentially, herding is absolutely another bias. Herding is interesting in terms of what it stems from. And the other thing you'll notice with a lot of these different kind of cognitive biases is that they stem from similar things and they overlap a lot. They're very infrequently discrete from one another. But yeah, like I said, I literally am building this out on the website for you guys so that whenever you want a reference of these different kind of decision-making faults and shit, you can find a ton of them. What led me to do this, honestly, was when I was building this for you guys. I was in the process of updating this tool, and I wanted to build like a more in-depth syllabus to at least give you some subtopics that I think you should focus on for each topic. This was the OG version, right? So this was supposed to be down and dirty, just send you down the right path, which was the hope here. But this is to give you some specific things that you should be learning in these topics. And take a look. I actually find this comical. Take a look at how many subtopics are in this one. 9. How many are in this one? 11. How many are in this one? 7. And then you get to trader behavior and decision making. How many are in here? 32. And this isn't even all of them. There's more that go in here. And then I keep going down and I realize this one has 10. This one has 10. This one has like 4. This one had 9. You get the point. What I'm highlighting is literally the densest section in this entire syllabus is this right here. And the reason why that's the case is, in my opinion, this is the difference between a successful trader or not. Now, it's not quite that simple because, in my opinion, the first differentiator is edge. Or do you have the capacity to build edge? That's not that difficult to do, right? Edge is there. Edge, there's structural alpha. There's different kinds of edge that exists objectively speaking. And they're not that, it's just not that difficult to find them. Now, off of that, what then becomes the difference? If we have access to the same tools, the same information, it's the individual trader. It's how they conduct business. So that comes down to decision making and understanding yourself really well to make good decisions. So yeah. Enix says, your opinion on a spread for RWT. We'll take a look. Some RWT. I swear if this is a penny stock. Okay, it's not. It's a REIT. What kind of spread? It has earnings coming up. You have to tell me. Yeah, you have to tell me what position you're thinking of. In a nutshell, as I look at this 6-month daily, bullish trending, Enix says call put. What kind of spread though? There's diagonal spreads, calendar spreads, vertical spreads. You gotta hook me up. To me, it looks like it's had a massive move. This almost ran like a small cap, essentially displaying very similar small cap behavior, meaning like the Russell 2000, like a lot of stuff in the Russell moved like this. And I see upward sloping standard deviation channels. I see the moving averages now all aligned as they should be. I see a little bit of topping behavior going on here. So for me, I like to see a break up above that of some sort. To the downside, it looks like it's channeling at this. So a break down below that, something like that. Inik says, sorry, bro, you speak like Chinese for me now. That's totally cool. So what I'm highlighting are different kinds of option spreads. So I forgot which part in the series it was. You'll have to go through the titles because I obviously don't remember. But there are different kind of structures you could put on. So a spread is a generalized type of option structure, but there's a lot of different kinds of spreads. So there are things called vertical spreads, diagonal spreads, calendar spreads, butterfly spreads, iron condors. Like those are all different kinds of spreads. The way to think about a spread in an options trade is essentially when you have an additional leg of some sort that offsets components of another leg. That's kind of the idea, more or less. So the way I would look at something like this personally is then if you're not sure like what kind of structure makes sense, then I would start it with what's the thesis? Do we think up, down, sideways? Which way do we think that RWT is set to move? And then from there, we can work. I mean, this is a great example of like building and framing a trade. We can work through that together. I got to open up the door for the pup. But that's where it starts. Anik says, I think up, but maybe hedging also. Those are literally completely different things. Hedging is the process of reducing risk of some capacity. Up, obviously, is a bullish direction. But if we're hedging, that means that we want to reduce downside risk, which means we think something is going to go to the downside. So I would offer to you that you have, right at the origin of your thesis, you have a conflicting thesis, in my opinion. So I think you have to start with defining what thesis you have. So for me, again, I see something that's trending upwards here. I don't really love REITs right now, but the main reason for that is, for those that don't know, I have a bunch of real estate that I've been building out into over time. So that's a part of the reason, right? Like I'm not looking for more real estate exposure in the market because I have it off and in the kind of physical sense. So for me, I wouldn't look to trade this in any sort of like significant holding capacity. Now, the other thing for me is it has earnings coming up, and I would want to know how it's performed during previous earnings. So we can see, wait, huh? This is a REIT. Now I'm very confused. Now I'm very, very confused. What? That doesn't make sense. Let me try another platform real quick. I'm going to grab ORATS. And for those that don't know, I am an affiliate for ORATS. If you like their platform, you can sign up with a link that's in the notes. You get, it's like 50% discount. It's a good discount. And it's a cool platform. I like it. But let me grab it really quick. Obviously, this isn't sponsored by them. I didn't know that I was going to use the tool, but I thought that I would give you the background on it. Paulo says some REITs pay good dividends. Yeah, but that's the problem, right? Like, again, people fuck up the idea of dividends. I would take capital gains every single day of the week and twice on Sunday over a good dividend. Like, I don't really care about a good dividend. I'm sure this has a great dividend, right? 8.65%. This is beautiful for the product. But what I care about is the price performance. And guess what? Like, that dividend doesn't help you when you have an underlying that's gone from fucking 20 down to 2 back up to 7. So yeah, like literally screw the dividend. People get too wrapped up about dividends, and I would always take a much lighter dividend, much lower percentage, with something that has much better capital gains. Now that's for total returns, right? That's not prescriptive for everything. There are scenarios where dividends might make a ton of sense, but I'm just saying in general. All right, so we need to look at RWT here. Let's see. So RWT is a shotgun blast. Yeah. So I don't like it for earnings. I wouldn't trade it for earnings personally. And so that would mean for me, I would wait until after earnings and see what it does. Rama Llama. Yo, thank you so much for the donation. Really appreciate it. That will go towards my dinner tonight, which is going to be Mexican food. Rama Llama says, felt content to enter a short iron condor. It was GME, which was unsuccessful, but excellent experience observing movements. Thoughts on iron condors? Thank you. Yeah, great question. So I do not like iron condors personally. It is not what I would trade at all. So the issue is they sacrifice too much in too many places, and I do not see them as overall like a favorable structure pretty much at all. So it's not what I would trade personally, is what that boils down to. Matt says thoughts on ASTS. Let's see. ASTS. Oh, this looks good. I mean, this thing is up and out. So the way I look at something like this is if you didn't get in today, it's getting late, like really late. That's how I would view this. So this is okay in terms of like a breakout play, but really this is the day I would want to enter on a breakout here. And then if I didn't get in on this breakout, I would definitely want to get in. I would have wanted to be in today because these are lower risk entries. So I don't dislike it. It's definitely moving and it's moving really well, but it just becomes a higher risk entry that I would have to manage the risk tighter and tighter in my opinion. So yeah, I don't dislike it. Paulo says they're safe though, iron condors. Yeah, who fucking cares, man? Like that's, again, like that's a problem with traders is you guys can get too focused on safe. If you want safe, put your money in a safe, right? Like if I'm looking for safe, the market is not where I'm going to take my money. When I'm going to the market with my money, it is for a return. And more often than not, the reason I get a return is because I'm taking risk. I'm not safe. So like I have a special place in my heart when I hear traders that are wanting to hedge all their positions. They don't want to have downside risk. How do I reduce risk? The way you reduce risk chiefly is by sizing trades that make sense for you. That's the first way. Before you ever put the trade on, size the trade so it makes sense. That's your first risk reduction tool. Size your trade well. After that, it's managing the trade. But this, like for iron condors, for example, just put on a short strangle and then manage the short strangle if you need to. So I think the problem is, again, like this obsession with risk aversion. And I think it's a problem. Ramalama says preferred strat for sideways moving stock or abandon that stock and trade something else. I think you're focusing on the wrong thing in that equation personally. So if there's a sideways moving stock, I don't care if the price direction is sideways. That's not one of my profit mechanisms that I leverage as a trader. So when I think about the way I trade, there's a handful of profit mechanisms, things that are directional or volatility, right? So like sideways isn't one of these. And the reason is Because if I want to trade something that's going sideways, which is actually a beautiful segue, great question. I don't know if you realized how good of a question this was, but it is a perfect segue into the trade that I was going to show you guys in something called path. There she goes. So what do you guys think I did in here? Why am I talking to you guys about this trade? Any ideas? Talk to me about what you see. And then I gotta step away for just 1 second. All right. Benoit says VRP trade. Yep, you got it. Exactly right. So this is something that is moving sideways, right? But the basis or the theory for my trade is not price sideways. I don't really care inherently if price is sideways. What I do care about, though, is if something has variance risk premium, and this does. So essentially, you can see I highlighted it for you. I have to pull it up here. Here is where I entered. It was on the 14th of June. And you can see essentially what I saw on the 14th of June, which is about right here. Just a really, really steady variance risk premium. And you'll notice that it actually started, the variance risk premium for the short-term time frame started building, and for the long-term time frame looked completely static. It had declined precipitously due to this drop, but it was still plenty attractive to me. So how did I trade this position? How do you guys think? How would I have traded variance risk premium in here? Any ideas? My dog is just like curled up in a little tiny ball. If you guys want me to bring him on the stream, let me know. I'm always happy to bother him and pick him up. Short strangle, puts. What other guesses we got? 2 good guesses so far. Short strangle and puts. Straddle, also great guess. Rutabaga, I'm too dumb for this, sir. As am I. I don't blame you. I'm right there with you. Elong Song says dog break. Here he goes. We have to change to this. So this is actually from him digging in his bed. He has like war paint on. He's got some there too. So here he is in all his glory. Say hello to the people. So he licked the mic. I think that tells me that he likes you guys. He looks generally unenthused. You kind of notice the face we got? What? Good boy. This is Thor, the champ. You guys see his mohawk still? He has a cool mohawk. We're a big fan of this. He's not like good at looking at the camera. Notice like whenever I point him that direction, he like diverts his eyes. But the one thing I would say is he has a tuxedo. He's more formal literally than all of you guys combined, because he essentially is always in his tuxedo. Fun fact. All right, let's get my face out of the way. Nobody wants to see that. Elong Songs, that was for you. It was time to see the pup. All right, so back to this. Fan of airplanes. I'm also a fan of airplanes, provided that they stay in the sky. I do not like airplanes that fail to do that. Great to see you. But Tom was correct. It was a short strangle. So I offered the 13 and the 11s at an average of 40 cents. 40 cents. So what does that tell you? Well, unfortunately, I needed to put on 10 million of them in order to essentially get any sort of size on that I wanted. But the basis for the trade is literally as simple as it gets. It's something that showed really good variance risk premiums, and it still does. So this is still completely well within play. And this is built around right here. It's literally still in my variance risk premium play scan. So there's different ways that I can come across the positions, and it's generally built based on a portfolio need. So then I'm generally looking for different ideas. But the big filter here is I don't want stuff with earnings. So you'll notice it doesn't have earnings coming up. And yeah, I mean, that's pretty much it. So just wanted to give you guys an example. The management of the trade was super simple. All I do is figure out where I want to manage it to the upside, set an alert, where I want to manage it to the downside, set an alert, or rest orders to close the position. Either or is completely fine. And then just let it go. Literally just let it go. And I ended up taking it to expiration just because it was behaving exceedingly well. But for these kinds of trades, I very often will manage them early. The only reason for that is because as you get closer to expiration, things like gamma do start to skyrocket. So the overall return on risk is not as good in like the last bits of the trade, typically the last week and a half, 2 weeks. That starts to get not good. The sheet says this is over my head a bit. That's a great question. So talk to me. What about this is over your head? What questions do you have? That's the whole point of these. And I'm glad that you spoke up and said that. Rutabaga says, what was the DTE? It's a great question. So the trade was put on 14 June and it went till 19 July. So that's the first component to the trade. So it is about a month. 14 June to 19 July. Now, this one in particular, I ended up keeping for the vast majority of the trade. But like I said, that's just because it was behaving. So you know that fuzz I picked off my dog's face? He's digging in his bed again. Thor, stop. And he has more fuzz on his face. Yep, that sounds perfect. Good. Good for him. So the sheet, tell me what questions you have. Hussein Sauce, what was your return like? That's another great question. So the trade was at $40. So let's just call it 40 per lot. The sheet says variance risk premium. What is it? Great question. So the first thing I'm going to do is actually give you a video that you can go deeper into detail on the concept, but I will summarize it for you. Simply put, variance risk premia is the tendency for implied volatility to be higher than realized volatility. So that means that there is a risk premia being priced into the options where we're pricing in a higher vol, obviously expecting slightly higher volatility than we realize. So that leads to an opportunity. That's the general concept behind that. So great question. And that's precisely what it is. As always, again, like if you have follow-ups on that, just let me know. I'm happy to dive in. Now, to figure out what this was, not HV. HV is the same thing. So in this context, as I'm framing it, realized vol is historic volatility. Same. Now, volatility can be really quirky in that there are different kinds of realized vol. You can have future realized vol, which is kind of weird, but you don't have to worry about that. I actually think in one of the earlier videos we did, but let me see. I think I have a video that really goes into like volatility pretty deep. Yeah, here you go. So this video goes a bit deeper into the concept of volatility so that you can kind of see. Tom says, how do you go about picking an expiration for the type of trade, and how do you see VRP for a certain amount of time before placing the trade? So I can care about persistence or magnitude of VRP. That will depend a little bit on the opportunity itself. So in this case, it's a little bit of both. I saw persistence over time and magnitude. And then in terms of expiration, that's more about the portfolio. It's less so about the individual trade. But like if there's earnings coming up, obviously I'll see how I feel about the earnings. If there are, other trades that are going to be coming down, like it's mostly going to come down to how is this thing going to fit into the portfolio. VRP plays, they're sloppy, right? Like I'm not really trying to maximize each element of the individual position because I'm just expecting to put on a fair number of these things, have a fair number of them work like total shit, and in the aggregate, have them make money. So it's an important differentiation, I think. But yeah, DTE, I think to give you at least something resembling an answer would be something between 2 weeks and 45 days, 50 days, something like that. I think that that's fair. The sheet says, or more important, let me see. The sheet says, so IV above HV is basically on the indicator. Yep, that's exactly it. Or more importantly, the change in IV versus HV versus before. Great questions. And the first one is that's correct. So this indicator is literally plotting a few different things. It's plotting implied volatility for different time frames. The plots you see here are for a week and then a month. And then these white lines are historic or realized volatility, past volatility. And you can see there's two different time frames. The dark is like 30-day realized, and then this is 5-day or 1 week realized. And then the purple lines with red, those are actually tracking the variance between those two. That's variance risk premiums. So notice how between this bright yellow and this white line, really big gap. And then you can see between the bright pink, how it turns super red. It's essentially the near perfect inverse of this. So that's essentially what that indicator is showing me. It's showing me volatility so that I can visualize it. Benoit. I won't get tired of that name, Benoit. It's a hilarious name. It reminds me of Archer. I don't remember if the dude's name was Benoit Balls, whatever that guy was, but that's what it reminds me of. Benoit says, what's the most appropriate profit mechanism to focus on capital preservation of a small account? Okay, well, I personally don't like those, right? Like the idea of capital preservation in a small account. If the goal is to preserve capital, it would be like dollar cost averaging into an index ETF using some sort of moving average momentum following strategy to play positive drift. That's kind of the way to preserve capital. Now, beyond that, assuming that we want to trade, and depending on what small capital means, let's just call it like sub 100,000, something like that. Then in that scenario, if the goal is to like really try to grow the portfolio, which would be my approach, would be trying to grow without having massive drawdowns, would be primarily direction strategies. So things like ratio diagonals. I have an old series on the playlist from it was called Small Stacks, and it's still there. That one hasn't gotten nuked yet, but that one goes through this entire process of trading a small account. Now, I traded both the covered strangle and the ratio diagonal. The ratio diagonal provided a much better return in that portfolio, but the covered strangle provided a little bit of like a keel where my P&L wasn't highly volatile because I had capital committed to that. So yeah, that's essentially the way that I would think about it. I personally would be trading ratio diagonals, and believe it or not, I have a video on this exact thing for like what account or what strategies I would use in a small account, which is right here. So you can check that video out. And then funny enough, the small stacks segment pops up. So I'll give you the first video in that segment here. And then it looks like there's 16 parts. It was a 3-month experiment. I made 26.85% over the 3 months. So not terrible, not great, but we still have money. So that part's cool, I guess. That's not so bad. Behemoth says, what delta do you use for strangles? It's not a fixed thing. It's highly dependent on the individual product. I would say general bands, though, would be anything from 40 deltas out to 5. If I had to ballpark an average, it would probably be like 30, I think, is a fair average normal go-to delta. But it is a specific metric. It's not something that's standardized just blindly. And again, like I know what you guys are trying to do, and it makes total sense to do that, where essentially we're trying to come up with like simplified heuristics for how to use these things. But the problem with that with options is that is another bias that you have. I have to find it 1 second. Might not be on here. Anyways, there's another bias essentially where we seek to oversimplify things. And I think that's partially what that is, like just trying to come up like what DTE to use or what delta to use. Like I said, I totally understand the origin of the questions, but it essentially will always be a variable component to some degree. And the reason for that is like that's the whole concept behind options, is to have that kind of variability, because without it, right, like if you didn't care about any of that stuff, all you would do then is trade the simplest expression, which would typically be the underlying itself. Let me see what that bias is called. I can't. Oh, fallacy of a single cause. Oh, no, that's not it. My bad. I'm not sure what it's called. I have to figure it out. But essentially, it's just oversimplification. That's the... Oh, I think it's attribution. Is that it? Let me see. Do I even have that in here? I don't. Ooh, we have another one we need to add. Yeah, I think it's attribution. No, not really. Damn. My bad. I thought I knew it. I can't remember. Simplicity or reductive bias? Is it simplicity? Simplicity bias. So I'm not sure if that's actually like a standard bias. Reductive, I think. Yeah, okay, so reductive bias. Thank you. That's what it's called. Thank you very much. Yeah, I was gonna say, I recently came across a bunch of these, right? Like as I was building out that page, and I'll actually add that one for you guys as well. But yeah, essentially when we try to oversimplify a lot of those components, we lose a lot of the details associated with them that kind of make them what they are, because they actually are kind of these, honestly, I would almost call them like magical concepts, because the cool thing about options is that there's a lot of variability that go into them. And in my opinion, that's kind of the benefit of them, is that you can very, very carefully structure them to be what you want them to be. So yeah, I think in this context, you can come up with general heuristics, which again, it's normal. And I think it's a good thing to do, because in doing that, you essentially simplify the way that we're analyzing information so that it's more palatable. But I think it's also important to make sure that we identify like what components make the most sense for what we're trying to do, and then make sure that we're prioritizing the correct components. So like, for example, when I hear something about the delta selection, you guys tell me, when you're selecting a delta, what's the trade-off? Let's say that we're picking the same expiration, same product, everything else is the exact same. But what's the trade-off when you're picking deltas? There's a few things that come to mind to me. Price to risk ratio, that's part of it for sure. Think of things like how much money you can make. Think about things like risk. Think about things like management, right? So what happens if I sell a 40 delta strangle versus a 10 delta strangle? What are the things that you guys can think of? And I want you to specifically to think about the overall P&L of the position. I want you guys to think about how the path of that position will look. 40 delta strangle versus a 10 delta strangle. You guys tell me, what's the difference? Depreciation, that's not it. It's a good guess, but that's not it. Risk of assignment, that's part of it. Bingo, Tom has it. Tom summarized it really well. So what Tom is highlighting is that you can make more money, but you're in a scenario where it's much more likely to give you problems. What's another thing? So let's take a look. Let's take a look in here for an example. And let's say that we're looking at something that's like 45 days out. Let's just pretend that these were liquid. You have to use the monthlies. Fine, we'll just use the 21 days. So using the 21 days, what do you guys notice about this 36 delta put as compared to this? I don't know why these are, oh, because the 10 and a halves. To like this 14 delta or 10 delta or something like that. There's another really important component. There's another Greek that you guys need to look at. Gamma, bingo. That's exactly correct. That's exactly correct. It's gamma. So the reason why we care about gamma is because that tells us that the path of our returns has the potential to be super painful. If you have an option that has a higher gamma, it tells us that its deltas can move a lot, and it tells us that the overall position will move tremendously more. So if you take a look at this 36 delta option here, it has a gamma of 28. If you take a look at the 14, 10 delta, whatever this actually is, because the options are kind of messed up here, this one has a gamma of 8. So that means for every 1 point move in the underlying, down here, your deltas are going to move by 28. And for every 1 point move in the underlying here, your deltas are going to move by 8. Much, much, much different behavior of the position. So that's why the decision of selecting deltas matters a lot. And that's why there's not a set answer on what delta to pick for something like a strangle, because it heavily depends on the product. It heavily depends on how this thing fits into your portfolio and how you want to manage it. Those are all the nuanced details. So for example, let's say that, let's literally go through an example. But before that, actually, let's take a quick look. We already saw this one on this idea of like how much effort goes into being successful. I think we already talked about that. We can kind of, this is perfect timing. We've talked about a bunch of those already. We can skip over that. Here, this is a great one. So we actually talked about this before. So do you guys remember when, who was it? Somebody was asking about that stock that we were looking at, the REIT, and they said, what do you think about a vertical in there? That's this, right? So that's a really, really common error and issue that traders will make. It's literally quintessential. It's like so common, right? That's why it's here. That whoever I did that example with, they did this exact thing where we focus on some element of a structure and not on the profit mechanism. So the misconception here is that a structure somehow makes a trade profitable, and it doesn't. A structure is just a way to capture a profit mechanism. Profit mechanism is what makes us money. So that's actually a great example of what we were reviewing before. Now, to take this example into this example now, this idea of a profit mechanism, if we're thinking about trading VRP, let's just pick something random. MSOS looks okay. That I don't love. GME looks great, but this is a unicorn. I would not have naked options in it. Same thing with Chewy. Let's use something like MSOS. We'll use something slightly different. So MSOS, let's say that we want to structure a variance risk premium trade in here. Let's just say for whatever reason, we like it. Doesn't look bad to me. And it doesn't have earnings coming up too soon. It doesn't look like. So now let me just double check really quick. I'm going to change this time frame so that it is just a little further out. Yeah. So it doesn't have earnings coming up just yet. So we have a little bit of time here. So let's say we want to structure our strangle. Let's say that we want to keep it in a primary expiration and we're stuck between two. You can either do 21 or 56. Neither one of these are optimal. So for me, depending on how the portfolio fits and all that kind of stuff, I'm going to trend towards this one, the 56. A little bit longer in duration, but for this style trade, I don't care about that. And it's for a bunch of different things. Now, opening this up, let's see what's in here. Benoit says pot ETF could be affected by political. Of course. Yeah, that's the thing, is everything has risks, right? Like, yeah, and I obviously appreciate the call out, but it doesn't matter to me. I'm coming in here literally to make money. So I expect to take risk. So if we take a look at something like this 32 delta and this 32 delta, and we plot this. Now, again, this is in a pass-through account that doesn't have any money. And the reason why that matters is because this is not a portfolio margin account. So we can see what the margin requirement would be for most people, which is super cheap, $837. So in this case, we'd be taking in about 83 bucks and we're putting up, let's just call it like 850, something like that. So it gives you a 9.8% return over that 56 days. Now, that does tell me that the risk in this is elevated because that is a pretty high return. Now, the other thing I need to see is, how do I want to manage this? Well, my break even to the downside is, let's call it six bucks, something like that. And that puts me at a $45 loss if we get there. And to the upside, it's about, let's call it 10 bucks, a little bit less than that, like 986. And that puts us at an $80 loss. So now I can go through the process of seeing what the probabilities is of those being hit, which is super simple. We do that in here. Based on that information, I validate that the risk makes sense compared to where I would be managing the trade. And then let's just assume that it makes sense. 986 down to 6. I would come in here and I would say, okay, I need to start getting out of this trade if it gets up to 986. So let's call it 970. I need an alert for up or above that. And then down to 6. I need an alert a little higher than that. Give me a minute to see it. So give it like 614, something like that. At or below that. And then trade goes off. So then the other scenario would be, okay, maybe I can trade this. What is this? 14 delta and this 14 delta. And we can compare this. In this case, I am making 30. So I'm making quite a bit less than the 83 that I would see. And if we have a move against us, again, break even to the downside is about 570. And at that point, I would be losing 43 bucks. And to the upside, break even is at 1130, and I'd be losing about 123 bucks. So the first thing you'll notice is I have better break evens, but I have worse severity when I get there. That has everything to do with the fact that I've collected way less money. I collected only 30 bucks as compared to 83. What's the payoff here? I have a much higher probability of this trade working out. So let's just use the worst scenario for a quick example. Let's say to the upside, my risk is at 1130, and I would be realizing a $124 loss. So if we look at 1130, the probability of hitting that in 20 September, look at the probability of a touch. What's the probability of us hitting 1130? 17.8% probability of being stopped out to the upside within our time frame. And then I forgot what it was in the other trade. It was like 9 something, right? 971, I think it was like 980. So let's say in the same time frame, what's the probability of us hitting 980? 37% chance. So there's a much higher probability of being stopped out in this trade than this trade, but you make more in this trade than you do in this trade. So now that's taking it to expiration. If I wanted to analyze, okay, I don't want to take it all the way to expiration. Let's say that I hold it until there's maybe 14 days left, something like that, something about 2 weeks, so something around here. What's the probability then if instead of managing it at the equivalent of this 20 September expiration, I'm managing it in the same DTE equivalent if I were to leave 2 weeks left, which would put me here at like the 30 AUG. Now, what's the probability of me hitting that 980? That probability is now 27% chance. And then the 1130 is like a 9.7% chance. So this is the game. And you have to figure out what makes the most sense. There is absolutely no right or wrong answer. But that's the exact process you can go through to see what makes sense. Let me know if that answers the question for you guys. Hussein says, would you consider delta for regular options, calls, puts? Of course. Delta is one of the primary inputs for literally every single trade that goes on unequivocally. The sheet says all things equal, look for the highest ratio of delta gamma. Nope, not at all. That will change massively, again, depending on the disposition, what I'm trying to trade, the underlying thesis. So I would not personally look for that, no. It's a good guess, but yeah. Tom says, I find myself picking delta based on strikes that align with my perception of support and resistance. Yeah, it doesn't matter. So like picking the delta at those levels doesn't matter. Because again, like that's not necessarily where the trade management is. You could essentially think about the idea of structuring the trade so that you would manage it at those support and resistance levels. So let's say, for example, you thought resistance was at 907. And you would want to get out for something that is above that, you can do that. You can structure your position so that it makes sense for management. But to make that selection based off delta and putting your delta where you think that is, to me, it's not, it doesn't make sense. It doesn't align unless you're just managing it when it gets to the strike inherently. But again, that's not how I do it. But if you were doing it that way, then it at least would make more sense. Benoit says, what time of day do you typically put on trades for new positions? This is a great question. Typically towards the end of the day. It depends on, for a new position, like a net new position. If I'm managing a trade, sometimes it'll be throughout the day, kind of whenever it comes up. And then I do put trades on and off in the morning. Again, like sometimes people, I think they get too binary when we have conversations like this. So it's important to reiterate that it's not that I never put trades on earlier, but I typically will put them on towards the end of the day. there's a different kind of liquidity that happens then, and you miss the first hour illiquidity and volatility rush, which I don't want to be a part of, just because you get way sloppier fills. So unless there's a specific reason for me to get filled or to enter at those times, I typically avoid it. Iceman says, when managing a trade that touches your break-evens, do you consider the amount of days that have passed prior to it touching? That is, how quickly it touches. No. So I assume we're talking about this trade that we were looking at. So specifically looking at the idea of like a short strangle, like a variance risk premium style trade, because the reason why I'm coming with that assumption is because that answer also would depend entirely on the strategy and what's being traded. But if I have something that hits the management point, then I would manage the trade. It doesn't matter if it happens quick. It doesn't matter if it happens later. When it's time to manage that position, that's why those things get defined before entry. And it has to marry up to the thesis. It's really, really important for those things to line up. Chewy says, how about picking buy gamma? No, I wouldn't pick buy gamma. I would have no issue for, like, obviously heavily including gamma. So like, for example, if I am trying to trade a long call strategy that includes an element that might rapidly expand the basis, what I would refer to them as kicker options, then the gamma matters a lot. That is an important decision component of that position. But I wouldn't pick just off of gamma, because I still would prioritize things like delta. So yeah, gamma can have heavier weighting in some instances, but I don't think I would base a trade completely off of it personally. Behemoth says, is it important to be mechanical buying back options like the tasty method of 50% profit? That's a great question. What do you guys think? If you guys were to answer Behemoth's question with him, or to explore that concept, what do you guys think? Because there's a few things that come to my mind with that specific thing. Chewy says kicker gamma, so higher gamma number. Yeah, exactly. So if I'm adding kicker options, which are lower probability of payout, but a higher compounding capability, I would use things that have higher gamma. Tom says, base it on the expectancy of the trade. That's part of it. That's actually not the first part in my opinion, but that definitely is part of it. What else do you guys think? Depends on your portfolio. That's a great component. And you guys I'm converting you guys to be it depends people. So you too will piss off everybody that asks you a simple question when you respond with it depends. Shane says, based on what I've been told, having a set rules is beneficial. Can be. I agree. So here's what I would say. I think it depends on the strategy as you design it. So if you have a strategy that's a little more geared towards discretionary, I don't think being purely mechanical is good. And I think the trader needs to maintain discretion. However, it also cannot be a random selection of things. So the way I look at that is I make sure that whatever rule set I'm applying generally makes sense. That's the first thing. So the next thing is to make sure, exactly as Tom highlighted, because if your strategy is baked on taking 50% profit, that's okay. But it needs to have an effective expected return based on that parameter. So the first decision that really depends on what route I would take that answer is if we're trying to devise a more mechanical strategy. If it's more mechanical, then yes, we need to decide how that mechanical approach will play out. If it's a more discretionary approach, then no. Then I think that can actually be a problem, and it needs to be a little more individualized to the opportunity. The issue that you have with things like taking things at a blanket 50% profit is it really does depend on how you're managing the losing side of the trade, and does it maintain positive expected return. Paulo says, why 50% and not 30 or 80? The reason why places like Tasty Trade do that is because they're trying to provide people a generally applicable set of rules to simplify things. That's why. So when you think about something like why 50% is because it applies to a lot of strategies in a lot of circumstances where it generally is okay. It loses a lot of specificity, which obviously I look for. I care about the details. So that's why I don't do something like that. Now, for me, if I'm trading a more mechanical variation of something like my 0DTE SPX strategies, for those kinds of things, I have a more mechanical profit-taking approach applied. And it's because it's like a numerically based strategy. It's the same thing with things like earnings plays. But for things like ratio diagonals, where there's a lot more discretion involved, I don't apply that same methodology. So it does depend quite a lot on the strategy. It's a good question, though. Fan of Airplane says, hey, Eric, do you think GME is a good spot to write covered calls? I am conflicted because IV keeps dropping, but I would like to make some money while the stock trades sideways. I mean, yeah, if you have long shares and you want to write calls against them, then that's okay. The component of IV contracting, that's one component of the trade, but like GameStop still has high IV. It's 90.5%. So you're going to get still a completely healthy return for selling calls. Now, to your point, you're not going to make as much if IVP were higher, but that still doesn't mean that you're not going to make money. You still absolutely will make money, provided that it does what you want, meaning not go blow through your short strike. Then obviously the short call will lose. But when trading something like covered calls, for me, volatility, specifically IVP or the relative volatility level, it's secondary. I don't care as much about that. As long as I'm getting a decent amount of money, as far as I can see, on what I'm capping in terms of upside potential, and I'm okay with that trade-off, then it's fine. But I wouldn't not make that kind of trade just because implied volatility is low and it might go against you temporarily, because that doesn't really matter. If you're going to hold the trade, then it still would make the money. It just would be a potential loser in the interim. So yeah, I wouldn't care about that at all. Next question, or next misconception: options are too risky. You guys should know the answer to this one by now. It's not that options are too risky or not risky enough. It is simply that options take whatever risk you give them. That's it. That's literally all there is to this. You can structure options trades that are very risky. You can structure options trades that are not risky at all. It is completely up to the way you build the trade. This one you guys should know about as well. So if you're buying a long call or a long put, there's a widely misunderstood concept that the stock price has to go to the strike price in order for you to make money. And that's not the case. Why is that not the case? And in the meantime, I'm going to answer Silly Russian's question, which is just hopped on. Want to say I love you and Newton. Yeah, Newton's awesome. Any tips on how to stop being a greedy degenerate? It can be very self-sabotaging with a tiny cash account. Yeah, I think for that, it comes down to developing a better roadmap for yourself that you respect. If you do not have respect for the roadmap that you've built for yourself, then there's no real incentive for you to follow it, especially if you're the kind of person to think that, you know, this short-term price movement can essentially change your life and that, you know, you should put all your money on it. The way I think about it is, if you develop a roadmap that you're highly, highly convicted in, then it's much easier to make those shorter term sacrifices and stuff like that, and to focus on the broader plan. So what does that look like? Really simple. Not that. I'm trying to grab this. It looks like this. if I'm 21 and I have $15,000 saved, and by the time I'm 35 ish, I know I want to have over $1 million. Well, it tells me a few things. It tells me I'm going to need to have a better rate of return, and it tells me I'm going to need to get really good at saving money. So if I get to the point where on average, I'm able to save $1,000 a month over the course of 14 years, and my return, I can target something around 15%, I'm close, but not quite. So you can see if I save just $100 more per month, I would be at $640,000. So depending on what this number feels like to you, then, and again, it's important because when you're 21, will you be able to put this away? Probably not, depending on how much money you make at 21, but it's probably not going to be enough to support that. But what I'm talking about is this on average, because you had better believe by the time you're in your late 20s, early 30s, you should be putting away way more than this. And if you're not doing that, you're not living essentially a viable lifestyle for your broader objectives. And you need to go into what I like to call monk mode. That's what I spent most of my early 20s in, what I call monk mode. And it's so that I could really amplify this and maximize my contributions as much as humanly possible. So then you could say, well, maybe I am able to save that extra $100 a month, makes a pretty big difference. And now let's say you look at a slightly different return variance profile where you say, well, plus or minus 3%, how can I do? And well, you realize if you're able to do 3% better than this 15, and that puts you at 18, now you're at $823,000. This takes somebody from a $15,000 account saving on average $1,100, which is a lot. But again, if you're able to get to this point and compensate later in your compounding approach, on average, it'll still work out for you. Then over a 14-year time span, by the time you're in your mid 30s, you can be very close to having that $1 million. So then the other thing you could say, well, maybe instead of when I'm 30, I could maybe do it, well, instead of 35, maybe I could do it when I'm 40. So that'll take us here. And now all of a sudden, that's now completely possible. And you have $1.3 million. So then we could say, well, instead of then saving that much money on a monthly basis, maybe I save $800, which is even more doable, but you've given yourself a longer runway. So what I'm highlighting is going through this process. You literally can use this tool. It's why I fucking built it on my website, because I use this all the time myself, but it'll give you a lot of clarity. So then going all the way back to this idea of like being a greedy degenerate, well, if I realize that the path of being a greedy degenerate can include stuff like this, where I might have really good years, but then if I have one not good year, it actually can really derail my growth. So for example, portfolio one here, both starting with $100,000. Portfolio one has a 10% return, 10%, 2%, 10%, 5%. The best year in portfolio one does not outperform the worst positive return from portfolio three. They both have generally positive years, but portfolio three has one negative year. That one negative year, even though they have a better average return of 8.6%, their compound annual growth rate is 6.87% over this 5-year period. So what I'm highlighting is that this drawdown is a massive problem, because this drawdown of 25%, it needs a 33.3% return to recover back to break even. So when you make these mistakes as a greedy new trader trying to grow a small amount of money into a big amount of money, the only thing we do is move the goalpost backwards. That's it. So that's the way, and that's really the general tip and advice I would give to somebody that's struggling with that, is to develop a process and a roadmap that you believe in, that you're comfortable with, that you're willing to commit to, and then commit to it. because the world of trading is interesting. In my early 20s, when I compared myself to all of my friends, I was actually worse off than a lot of them. And then in my mid 20s, I started noticing a little bit of a difference. Then in my late 20s, I started noticing a pretty big difference. Now in my early 30s, I notice a massive difference between me and most of my friends. We're at completely different places financially. And it's because of adherence to this. While a lot of them in their early 20s were fucking around. They wanted to go out to the bars, have a bunch of fun, which I get that. That's really attractive. That's super fun. But it's really difficult to essentially become a self-made millionaire without making sacrifices of some sort. They got to come from somewhere. And if you want to do that in a relatively compressed time frame, like by your late 20s or early 30s, you have to sacrifice even more. But if you do, it can be very worth it. That's the tip. That's the advice. Create a plan that you truly believe in and then prioritize the plan. It's exactly what I would do. It's exactly what I did. I think that that works exceedingly well. Let me know if that answers your question, silly Russian. Now, going back to this, Hussein says because of things such as time volatility, price movement up or down, that's not it actually. The reason why this is a common misconception and why this doesn't matter is like, you don't need the underlying to go to your strike to make money on a long option. As long as it goes in your direction, the option will make money. Again, ceteris paribus, everything else remaining the same. Let's look at an example. If we look at, let's go to Tesla. And let's go here to 25 June. Let's buy, this might be even better actually. Let's go to the 12th, something that's not as aggressive of a move. Because then the 13th, there is a decent sized move. Let's see. So here, oh, I just got such a good hip pop. It's like that really satisfying crack. And now my nose is super itchy. I realize that when I talk a lot, my nose gets itchy. I don't know what that is. I actually think it's like my nose hairs that are vibrating too much. Fun fact, by the way. All right, let's see these options. And then let's do something that's like 37 days out. And let's pick an out of the money option. Let's pick these 190s. So let's pretend that those got put on for like 590. Now let's fast forward to the 13th. Let's see what happened here. So on the 13th, we had a little gap up, a little bit of vol because we gapped up and started closing back down. But you can see we're not at our strike. Our strike, I think, was 190, something like that. Yeah. But look what happened. We got in for 590. It's trading for 1120 now. This option made a decent amount of money. Yet, it did not hit our strike. It went in the correct direction. The other thing, notice, this isn't some really short-term dated option. These are 36 DTE options, and this is looking at the passage of a single day. Yet, the trade made money. How is that? It's because you don't need the underlying to go to your strike in order to make money. Like that's literally the punchline to this. It doesn't need to do that. You can make money with this kind of position as long as you get an accommodating move. This is another really common misconception. All right, we got another question here from Paulo. When do you roll a strangle into a straddle versus realize a loss? I don't really roll them into straddles very much. And realizing a loss typically happens at the predefined P&L target. I don't bother rolling things like straddles or strangles too frequently. Like if it's not working, it's not working. I'll close the trade, accept that it didn't work, and then just move on to another trade. Something like that. Like there's not a giant benefit to me to keep attempting to force the trade to work. I tend to take slightly more care in terms of how I'm selecting P&L targets and stuff like that. That's not to say, again, that I never will roll, but that's definitely just not my go-to. I typically will do a slightly, simpler approach on setting targets ahead of time. Next one. Buying is better than selling or vice versa. This is one of the most common misconceptions I see. There is this wild misconception that theta is some sort of edge. That's another kind of tied version of this. So if one was better than the other, why would anybody do the other? Just doesn't make sense. So the way to think about buying or selling is they both have their strengths and weaknesses. They both have their pros and their cons. But one is not inherently better than the other. They do different things. That's the way to think about that. This is a really common one. You guys, I bet you some of you probably think this right now. There's 40 of you on the stream right now. My guess is at least one of you probably think this, that if you're selling options, that going further out of the money is safer. What does that mean to you? And why do you think I might frame it as that might not be the truth? That might not be the case. Any ideas? And then Silly Russian says, absolutely going to dive into your resources. Yeah, that's awesome. That's great. There's a lot that you can do. If I were in your shoes, Silly Russian, you can check out like my 101 playlists. I think that's where I would go. So Silly Russian, this one. Benoit says it's just less likely to happen, but when it does, it will be worse. Will it be worse though? So for example, let's flip the script here. Let's look at here, 22 April to 29 April. Let's go there real quick. 22 April. Let's say we sell a call. We know it's going to go up. Let's sell a call. We'll sell 2 calls. Because Benoit, what you're seeing actually is not fully correct. And I want to show you why. So in this case, let's pick a 30 delta short here. I'm going to throw this in the chat so that I remember. So the 155 calls is at 440. We'll just do it at the natural price. So we'll do the sell to open here. And these are a 31 delta. So 0.31 delta. Now let's take a look at these ones. Sold to open, the 190 calls. You're going to get 53 cents for those. And then those are at a 0.05 delta. Cool. Now, let's go forward. What is it, like a week to the 29th, I said? Yep, that's right. Let's see what happens here. So our 5 deltas, which were the 190s here, they become 47 deltas and they represent essentially like 785, something like that. So now we sold something for 53. We got to buy it back for 785. So that's a negative 732 loss on the 005 delta. Now let's take a look at these 155s. These are now trading for 32.82. So we sold something for 440 and we have to close it out for 32.82. That's a negative 2,842. Negative 2842 on the 31 delta. So what do you guys think about that? Does that align with what Benoit showed us? It does not. Why is that? Why does it behave that way? There's a few things you have to pay attention to. Benoit says, but the position size was very different. The risk capital wasn't the same. It's a one lot for both. So the margin requirement for both of these is not going to be wildly different. It will be different to your point, but I don't think it will be wildly different. Let's double check. So we went back in time again. We're going to check at these. What is it? The 155s? Yeah. Let's see what the margin requirement is for these. These want $2,600. Now let's take a look at the 05s. These want $2,100. So no, I also disagree with you there, Benoit. The position size is actually not that different. This is Reg T margin. They're going to require very, very similar sizes based on a naked short call that are only this far apart. So also good guess, but also incorrect. It's super simple. The reason why these don't lose more money as a gross dollar amount is because they have a lower delta. It's literally the start of the trade. Because remember, these 155s are going to have a higher gamma and a higher delta. So after we get that first $1 move against us, these 155s are going to move against us $31. These 5s are only going to move against us $5. That's it. That's on the first $1 move. The gamma on these super far out of the money options hasn't started to change that much yet. So maybe on that next dollar move, you only lose $5 again. In this case, your gamma already gained 1 gamma. So your 31 deltas became 32. So you lost $31 on the first point move. Now $32 on the second point move. So you're at what? $63 loss on a 2-point move. $10 loss, 2-point move. It's exactly why that the severity on these is not going to be as bad because they're further away. Now, the caveat here is that the return on the risk is slightly different because these you're only collecting 50 cents. These you're collecting $4 and change. So the return on the risk has a slightly different profile. But the further out of the money, that's the trade-off. That's why you make so much less, is because there's a lot less risk total in this position. Now, you have to also think about the realized P&L or the realized loss against what you stood to gain, the return on your risk. And if you don't have such an extreme example, but let's say you have an example where the underlying just goes to at the money. So let's say that, let's just pretend that there's a move that takes these 155s and it makes them behave like these 140s where they go at the money, right? So in this case, you stood to make $442 if we have that move that essentially takes us to be at the money, which would be here. It's about a 10-point move or a 15-point move. Let's say a 15-point move happens against those short calls. These, you sold them for 442. They'd be trading for 1010, right? So that would be your loss. Now, let's say the same move happens for these 190s. You stood to make $53. You get a 15-point move. So these 190s would look like the 155s-ish. A little further out. These would still show a lower loss, but it would be a higher relative loss to what you stood to make. So I think that's what Benoit was attempting to convey in that scenario, but that's only one scenario. In a gross dollar amount, you'll still do better in terms of reducing your risk. So the reason why I say further out of the money, safer for short options is a misconception is because that perception of safety is relative to when risk is eventually realized. Because if you make $50, $50, $50, $50 in this scenario, right? So let's just use the same similar scenario here. You make $455 on these 235s. And let's say you do that a bunch of times and you make money. You make a bunch of money a few times. 5 trades in, you've made that $455. Then on the 6th trade, it goes here and you're now at $9. Well, this one, you would have made money. Your system is okay. In this one, you probably didn't make money because let's just call it 50 cents. If you make 50 cents, $50, 5 times in a row, you get your 250, whatever. And then on your 6th trade, it goes here. You're now net loss. So the problem with the safer options being further out of the money is that when a big move eventually happens, it can be big enough to essentially kick you out of all of the profit you've made because it's not much. That's why they're not safer. Couple more. Being an options trader. What I'm alluding to here is don't be any kind of trader. Just be a trader. Don't be a day trader. Don't be a spread trader. Don't be a long trader. Don't be a short trader. Don't be a stock trader. Don't be an options trader. Just be a trader. Be whatever makes sense. Focus on making money. That's what matters here. Next thing is rolling avoids losses. This one's a pet peeve of mine. Rolling does the exact opposite. Rolling realizes the P&L of a trade and it offers the opportunity in a new trade to overwhelm the previous losses. So this video is about rolling options, myths versus reality. This one is just kind of a general best practices masterclass. And then this one is kind of like a step-by-step guide on like the decision cycle behind rolling options. So those are 3 sources for you there. Last one, market is out to get you. I put this in here because people like to blame all kinds of things all the time. Market makers trying to get them. Somebody's trying to get them. And it, again, is handing the keys of control over to somebody else. And there's no reason to do that. It is all about taking as much responsibility as you can and figuring out how you can affect outcomes. That's what the entire focus is here. That alone. Nobody's out to get you. Nobody cares about you. They're just trying to make money just like other people are trying to make money. But by focusing on the things you can control, taking responsibility for things don't go your way, that feeds the system to eventually optimize it and find something that works. If you think something is out to get you, then it's really difficult to manage around that. It's not. The way that the market is out to get you is that it's competitive and it's looking for easy money. That's a thing. And that will be the case. And you have to learn how to operate in that environment. So these are 12 misconceptions related to options trading, and obviously a bunch of individual random offshoots we took along the way, but I had a blast. I love talking about this stuff with you guys. The next session for next Friday will still be in options trading for beginners. I have a couple other things that I want to work through with you guys. And then we're going to transform this into what I would call an options trading bootcamp series, which is just going to be pivoting it more to the practical application of this. And it'll be less theoretical concepts. But I hope the information is useful for you. And as always, if you guys have any questions, let me know. And the last thing I'll note is tomorrow I am doing that GME live stream if you guys want to check that out. And if you're not a part of the Outlier Discord, it's completely free to join. I encourage you to do so. Tons of cool people in there and great learning resources. So enjoy the rest of your evening. For those that want to do the GME live stream, I'll see you tomorrow. And then for the Outlier Pro members, I'll see you Sunday for a market prep session. And thank you very much for TGO1 for the $20. Really appreciate that. Thank you. That will go directly towards my dinner. That'll hook me up with a burrito, carne asada burrito. That's what we're targeting here. So thank you very much. I appreciate that generosity a lot. Thank you. Awesome, you guys. I will see you all around. Be an outlier. Catch you guys later.